Welcome back, and if you're watching this right now, there's a good chance you've already been paying attention to something in the financial world that most people are still completely ignoring. Something that doesn't make the front page of major newspapers and certainly doesn't trend on social media. But the data is sitting right there in plain sight. And when you step back and look at all of it together, a very clear and serious picture starts to form. Today we're going to talk about silver. Not as some fringe obsession or a relic of the past, but as a real asset sitting at the intersection of industrial necessity, macroeconomic pressure, and a market structure that, by almost every measurable indicator, is approaching a breaking point. So if you've got 15 or 20 minutes, stick with me, because by the end of this video, you're going to see this market in a completely different way. Let's start with the big picture, because context matters more than anything else when you're trying to understand a shift of this magnitude. We are living through a period in economic history that is genuinely unlike much of what came before it. Central banks around the world spent years printing money at a pace never seen before. Government debt levels in the United States have crossed numbers most people can't even visualize. Inflation came down from its peaks, but left a permanent mark on the cost of everyday life for working Americans. And heading right in the middle of all of that is a commodity that has been used as a store of value for thousands of years and is now simultaneously becoming one of the most critical industrial inputs on the planet. That commodity is silver. And the story of what is happening to it right now is one of the most important financial stories you probably haven't heard, told all in one place. To understand why silver matters so much in this moment, you first need to understand that silver is not just one thing. It plays two completely different roles in the global economy at the same time, and the duality is what makes the current situation so unusual. On one side, silver is a monetary metal, it has been used as money, as savings, as a hedge against inflation and currency debasement for literally thousands of years. Every major civilization in human history has recognized silver as a form of real wealth. On the other side, silver is an industrial commodity. It conducts electricity better than any other metal on Earth. It is used in electronics, medicine, water purification, and increasingly in some of the fastest-growing technology sectors of our time. Solar panels, electric vehicles, 5G networks, semiconductors, artificial intelligence, hardware. Silver is inside all of it. And right now, both sides of silver's identity are being pulled by enormous forces simultaneously, and the market is struggling to keep up. Let's talk about the supply side first, because this is where the structural story begins. For multiple years running, the silver market has produced less silver than the world has actually consumed. That is called a supply deficit. And it is not a trivial thing. When a market consistently uses more of something than it produces, one of two things eventually has to happen. Either supply increases to meet demand, or price rises to balance the equation. There is no third option. The math doesn't allow for it. Now, silver mines are not simple operations you can switch on overnight. Finding a major new silver deposit takes years of exploration. Getting a mine permitted and built takes more years on top of that. And here's the part most people don't think about. Most of the silver mined in the world, something in the range of 70 to 80%, depending on the year, doesn't come from dedicated silver mines at all. It comes as a byproduct of mining for other metals like copper, zinc, and lead. So silver production isn't even primarily driven by silver prices. It's driven by demand for those other base metals. That means the supply response to a silver shortage is slow, uncertain, and largely outside the control of anyone specifically trying to produce more silver. That structural rigidity is one of the key reasons why silver deficits, once established, tend to persist. Now think about what has happened to demand during this same period. The global push toward clean energy has created what economists call a structural demand shift, meaning it's not a temporary spike, it's a permanent change in the baseline level of consumption. And silver is right at the center of it. Take solar energy first. Every solar panel manufactured contains silver. Silver paste is used in the photovoltaic cells that convert sunlight into electricity, and it is not a small amount. The average solar panel uses somewhere between 15 and 20 milligrams of silver per watt of capacity. Now multiply that across the hundreds of gigawatts of solar capacity that governments around the world are building out, and you start to get a sense of the scale. Global solar installations have been breaking records year after year, and every single panel in every single one of those installations needs silver. That demand doesn't go away. It grows. Then there's electric vehicles. A modern EV uses roughly twice as much silver as a conventional gasoline-powered car. The silver shows up in the battery management systems, in the charging infrastructure, in the electrical connectors throughout the vehicle. And beyond EVs and solar, you have 5G network infrastructure using silver in its components and base stations. You have the growth of artificial intelligence requiring massive amounts of semiconductor hardware, and semiconductors require silver. You have the medical sector using silver's antibacterial properties in wound dressings and medical devices. The demand story for silver is not coming from one direction. It is coming from multiple major sectors simultaneously, all of which are in structural growth phases. That is an extraordinarily unusual setup for any commodity. Now here is where the story gets into territory that is genuinely important for everyday investors to understand, and it requires us to talk about the gold-to-silver ratio. Let's break this down because it sounds technical, but the concept is simple. The gold-to-silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. If gold is trading at $2,000 an ounce and silver is at $25 an ounce, the ratio is 80 to 1. Now, why does this matter? Because historically, over long periods of time, this ratio has averaged somewhere between 40 and 60 to 1. It has sometimes spiked higher during periods of market stress, but it has also compressed much lower during periods when silver outperformed. Right now, as we sit here in 2026, the gold-to-silver ratio has been trading above 80 to 1 for an extended period. By historical standards, that means silver is extraordinarily cheap relative to gold. It doesn't tell you exactly when silver will catch up. Markets can stay out of alignment for longer than most people expect, but the direction history suggests is clear. When the ratio is this elevated, silver has historically tended to outperform gold significantly as the ratio normalizes. Think about it this way. Imagine you found out that for the last several decades, the average price of a cup of coffee at a particular cafe was $3, and you walked in today and found that same cup selling for $1.50. You might not know exactly when the price would go back up, but you would probably recognize that the current price represents a significant discount from the historical norm, and that prices tend to return toward that norm over time. The gold-to-silver ratio works similarly. It doesn't give you a precise timeline, but when it's this far from its historical average, it tells you something meaningful about relative value. Now I want to address something directly because intellectual honesty matters here. Why has silver been underperforming gold by this much for this long? Part of the answer is that silver's market is much smaller than gold's in dollar terms, which makes it more volatile and more subject to short-term price movements driven by financial market mechanics rather than pure fundamentals. Part of the answer is that the paper silver market, meaning the contracts and derivatives traded on exchanges like the COMEX in New York, is enormous relative to the physical silver market. A relatively small number of large institutional participants have historically had significant influence over short-term price direction, and part of the answer is simply that investor attention has been elsewhere. Gold captured the narrative around inflation and monetary debasement in a way that silver didn't fully share, even though silver's fundamental case is arguably just as strong given the industrial demand story layered on top. If you're finding this useful and you want to keep understanding these kinds of market dynamics, now would be a great time to hit that like button and subscribe to John Smith Moto 2 if you haven't already. It helps this channel reach more people who are trying to make sense of what's happening in these markets, and it helps me keep producing this kind of content for you. I really appreciate it. Let's talk about what a structural silver deficit actually means in practice over time. When we say the market has been running a supply deficit, what that means concretely is that the silver consumed each year by industry, by investors buying physical coins and bars, by jewelry makers, by technology manufacturers, exceeds what mining and recycling produces. The difference has to come from somewhere, and that somewhere is existing above-ground stockpiles. Think of those stockpiles as a bank account the market is drawing down year after year. For a while, that works fine because the account has enough to cover the withdrawals. But if withdrawals consistently exceed deposits, at some point, the account balance reaches a level where the market can no longer function smoothly. Physical silver becomes difficult to source at current prices. Premiums over the spot price rise. Delivery timelines lengthen, and eventually the price has to move to reflect the real scarcity. The silver held in exchange vaults like those at the COMEX has seen its available inventory fluctuate in ways that the market watches closely. And the broader trend of multi-year deficits drawing down available supplies is not something the market can absorb indefinitely. Here's what this means practically. The supply deficit story is not about what might happen if conditions change. It's about what has already been happening, structurally and measurably, for multiple years. The demand from green technology is not a forecast. It is an already occurring reality that is accelerating. The gold-to-silver ratio above 80-to-1 is not theoretical. It is the current observable condition of the market. These are documented, measurable facts. And that combination of persistent deficits, growing industrial demand, historically high ratio, and relatively small investor attention is what creates what some analysts describe as a coiled spring in this market. The pressure is building. The question is about timing, not direction. Let's talk about the macroeconomic backdrop, because silver doesn't exist in a vacuum. The United States is carrying a national debt that most serious economists consider unsustainable on its current trajectory. The interest payments alone have become one of the largest line items in the federal budget. That creates a situation where policymakers have incentives to keep real interest rates lower than they might otherwise be, or to tolerate a certain level of inflation, because both of those things make the debt burden more manageable. And real assets, meaning physical things with intrinsic value, have historically performed well in environments characterized by monetary inflation and currency debasement. This story has been told before in the 1970s, in the early 2000s, in the post-2008 period. The characters change, but the underlying dynamic repeats. There is also a geopolitical dimension worth acknowledging. Central banks around the world have been buying gold at some of the highest rates seen in decades, and supply chains for critical materials are increasingly viewed through a national security lens. Countries are thinking seriously about where they source their silver, their copper, their lithium, because recent years have shown how fragile those global supply chains can be. That adds another layer of structural support to the case for critical industrial metals like silver. Now let's address the risks and counterarguments, because a one-sided story is not what this channel is about. The bearish case for silver goes something like this. First, technology changes. Solar panel manufacturers may continue finding ways to reduce silver content per panel, and alternative materials could partially substitute for silver in certain applications. Second, economic slowdowns reduce industrial demand. If the global economy enters a significant recession, industrial use of silver contracts, which can weigh on the price even while the monetary demand side holds up. Third, the paper market is large and can suppress prices in the short term in ways that disconnect from fundamentals for extended periods. Silver can be a frustrating and volatile market to follow. Fourth, there is the opportunity-cost argument. If other assets are performing well, money may not flow into silver even if the fundamental case is strong. These are real considerations that deserve acknowledgement. The silver market does not operate with a guarantee. No market does. But the risk-balanced view looks like this. Multiple structural factors are pointing in the same direction at the same time, while the risks mostly revolve around timing and volatility rather than the fundamental direction of the underlying forces. The demand from green technology is unlikely to reverse. The supply response is slow by structural necessity. The macroeconomic environment continues to favor real assets. Even accounting for legitimate risks, the asymmetry of the setup is notable. Here's a simple mental framework for thinking about this. The silver market has three separate drivers operating simultaneously. The first is the industrial demand engine, which is structural, growing, and largely non-discretionary, meaning manufacturers and technology companies need silver regardless of what's happening in financial markets. The second is the monetary demand engine, which responds to inflation, currency concerns, and economic uncertainty, and which can turn on very quickly when investors get worried about the purchasing power of their savings. The third is the supply constraint, which is slow-moving and structural, meaning it doesn't respond quickly to price changes or demand increases. When all three drivers operate in the same direction at the same time, as they appear to be right now, the pressure on the market builds in a way that is qualitatively different from periods when only one or two of those factors are in play. Historically, the moments when silver has made its most dramatic price moves have been when the monetary demand engine kicked in sharply while industrial demand was already running and supply was already constrained. Monetary demand can switch from low to high very quickly because it is driven by investor sentiment rather than slow-moving production decisions. When that switch flips, the market must absorb a sudden spike in buying interest against a supply structure that simply cannot respond quickly. For everyday investors and working professionals thinking about what this means for their own financial decisions, I have to be clear, this video is not financial advice, and no YouTube video should drive any specific financial decision you make. What I can do is frame the consideration honestly. The question isn't really whether silver will go up. The question is whether it makes sense to have some exposure to real assets in an environment where currency debasement, persistent inflation, and structural supply-demand imbalances in critical commodities are all present simultaneously. That is a question worth sitting with seriously. There are different ways people gain exposure to silver. Physical coins or bars give you the most direct connection to the underlying asset and eliminate counterparty risk, but require storage and carry higher transaction costs. Silver ETFs give you easy, liquid exposure to the price without the storage challenge. Silver mining stocks offer leveraged exposure, meaning they tend to move more dramatically than silver itself in both directions. None of these is inherently right or wrong. The right approach depends on your circumstances, risk tolerance, and overall financial situation, which is exactly the kind of conversation worth having with a qualified financial professional. What is worth saying clearly is this. The window during which silver sits in relative obscurity and relative undervaluation by historical standards is not permanent. Markets have a way of eventually pricing in realities that have been building in the background. The investors who benefited most from precious metals runs in the past were the ones who understood the macro case before the mainstream narrative caught up. Whether this moment in 2026 is the beginning of a similar dynamic is something only the future can confirm, but the structural indicators that have historically preceded such moves are present right now. Let me give you a clean summary of the core story we've walked through today. The silver market has been running persistent supply deficits for multiple years, meaning the world is consuming more silver than it is producing. Industrial demand from solar energy, electric vehicles, 5G infrastructure, semiconductors, and other green and digital technologies is growing structurally and is unlikely to reverse. The gold-to-silver ratio has been elevated well above its historical averages for an extended period, suggesting silver is historically cheap relative to gold. The macroeconomic environment, characterized by elevated government debt, monetary expansion, and persistent inflation pressures, has historically been favorable for real assets, including silver. And the supply response to these conditions is slow by the structural nature of mining, meaning the market cannot quickly correct the imbalance even if it wanted to. That combination of factors is not guaranteed to produce any specific outcome by any specific date. That is not how markets work. But the structural picture being painted is one that serious, thoughtful investors take very seriously. The silver alarm is not ringing loudly yet in the mainstream financial conversation. But the underlying data that would justify that alarm is already there, already measurable, and already documented. The question is whether you're hearing it now while the window is still open, or later, when the price has already moved and the narrative has caught up. Thank you for spending this time with me today. If this video helped you see the silver market in a way you hadn't before, I'd really appreciate a like and sharing it with someone who is thinking seriously about protecting their financial future. And if you're new here, subscribing to John Smith EO2 means you won't miss the next time we go deep on a topic that matters to real investors navigating a complicated economic world. Stay informed, stay patient, and I'll see you in the next one.